Well, good afternoon and welcome to our latest Tech Talk of 2021 and hopefully our last remote session. I think I said that last time, but I really do hope that is the case now. For those of you that don't know me, my name's Jill Painter and I'm Head of Membership and Engine at the Investment Association. Today we're going to be exploring distributed ledger technology again, and this time looking at the deconstruction and Uberisation of investment management, the why, the what and the when. DLT has the ability to improve data and identity security, enhance operational efficiency and streamline regulatory compliance as well as reporting functions. I think we're all very clear that the theory is sound, but any threat to the norm attracts scrutiny, and to succeed it must harness a collective desire for change. But what are the real pinch points today, and where should we plan for tomorrow? And ultimately, what is everyone else doing? When we last looked at DLT about 12 months ago now, I think I asked you to imagine a world without a smartphone. Now I'm asking you to imagine buying something with cash or travelling over an hour for a meeting when a video call is more acceptable. In fact, actually often preferred these days, just like now. These 2 points illustrate just how innovation has created efficiencies and in many ways vastly improved the experience as we get smarter at working and socialising. In fact, it's hard to believe that Apple introduced the iPhone back in 2007, and we haven't looked back since then. It was around this time, I think we all know, that Bitcoin was born and marked a global uptick in the development of distributed ledger technology. But the question has to be, how far have we really advanced in the last 14 years? And are we still in the trough of disillusionment, or are we finally on the slope of enlightenment? There's a real feeling that within the next 2 years, we'll see significant strides made in terms of real rollout and adoption of DLT within financial services. And I'm delighted today that we have some great speakers with fantastic insight as we hear from Jeet Singh at EY, who'll be discussing distributed ledger technology in investment management, the current landscape, pinch points, driving change, and the regulatory hurdles. We'll then hand over to Josh Wade at Calastone, and Josh will be looking at the reality of establishing a new infrastructure to meet the needs of tomorrow's investors. And finally, we have our illustrious panel that will be exploring the usage of DLT by funds, looking at the imminent prospect of digital or tokenized funds, as well as the advantages of digitizing traditional assets and emerging crypto assets. John Allen, our Senior Policy Specialist at the IA, will, with a specific focus on technology, will be moderating the panel and will be joined by Edward Glynn, Global Head of Capital Markets at Calastone, Brian McNulty, CEO of Fund Admin Chain, Josh Goodbody, COO at Credo, and we welcome back Jeet, Partner at EY. So we've got a great day, well, a great session ahead. But before we officially kick off, just a few housekeeping points. Please use the chat facility to ask any questions at any point. We're keen to make this session as interactive and discursive as possible. We also have a couple of polls today, so please do let us know your thoughts. All speakers will ensure they're on mute and not off camera unless they're talking, and during the presentation, all participants will remain in listen-only mode. The great news is this event is being recorded and will be available on the IA and Engine websites for you to watch at a later date or look back on any points made today. Of course, your feedback is hugely valued and always helps us improve our webinars. So please, I'd appreciate it if you could take a moment to complete the evaluation form that will pop up at the end. And finally, apologies for any cats, dogs, delivery men or children that make their usual unplanned appearance. So thank you all for joining us today, and without further ado, I'll hand over to you, Jeet.
Thank you very much, Gillian, and hopefully this is coming over loud and clear. The ask was quite a big ask to cover current landscape, pinch points, driving change, and regulatory hurdles. So I have tried to do my best. But I was first going to kick off, hopefully, with a poll question. And while everybody's filling up the poll question, I was going to just have a little chat and say, I'm Jeet Singh. I'm a partner at EY. Some of you may know me from the work I've already been doing in the wealth and asset management sector with regards to risk and regulation. And I've recently been asked to lead assurance for blockchain across EMEA. because we actually see a lot of overlap between current risk and regulation and where we need to go. So hopefully an insightful session now coming up for me, and also really looking forward to seeing some questions appear on the chat to get your views. But it would be great if you all could click on the button and answer the poll that hopefully is flashed up on your screens in front of you. Are you aware of any distributed ledger technology used in your organization at this time? I think we give people about a minute or so. So hopefully you've all clicked the relevant buttons on your screen. Aha, okay. Well, thank you very much, Evelina, for running that. Interesting stats there. So 22% say that they are aware, and 78% say that they are not aware. So, you know, and I think, to be honest, I think that's about what it doesn't feel wrong. Let me put it that way to some of the conversations that are happening in the industry. But I also think that, and hopefully, I know this is quite a busy slide in front of you. I understand the slides will be distributed to you. But I think what I'm really wanted to just touch on is some of our own numbers and our own sort of work that we as EY have done in this area, which might be interesting to you with regards to some of the sampling that we have done across organizations. So when we speak to the traditional banks in regards to what they're doing, 91% tell us that they are actually doing some sort of digital asset type offering. 73% of the various banks or asset services involved in custody tell us that they are also looking at the digital asset space and are currently already have live projects in the space. And last but not least, about 27% of people tell us that they are also actively looking at tokenization. But what I did want to do before I dive in any further is to just talk firstly about distributed ledger technology and DLT. And I think it's really important that we remember that DLT is the technology, and that's different from cryptocurrencies or digital assets. Cryptocurrencies, digital assets, etc., they exist on the rails of distributed ledger technology, but I really wanted to bifurcate this and ensure that we talk about, you know, distributed ledger technology separately from the cryptocurrencies. Yes, they are linked, but I think sometimes the conversation gets a bit pulled towards the cryptocurrency side, and I think it's important for us to spend a little bit of time, you know, just talking about the technology, which we see as technology which allows simultaneous access, validation, and record updating in an immutable manner across a network that's spread across multiple entities or locations. On the right-hand side of the slide in front of you, you know, lots of names there of many different firms. This is just a small snapshot from our own sort of, you know, research that we have done with regards to all the different activities and initiatives that are happening in the industry. And I think the interesting thing to me, to be honest, is the broad breadth of these initiatives. So, you know, in those initiatives, you will see trading, you will see settlement, you will see identity, you will see bond trading, you will see repos, you will see, you know, RTGS type conversations, etc. And to me, what's really interesting when you look across the landscape for me is that actually there is a lot happening in the distributable technology landscape in the investment management industry, and one which we are going to hear more about for some of the other participants in the webinar as well. One of the points, and if we could flip to the next slide now, but one of the couple of points I did also want to draw out was some of the success factors. If I could see this, if I could put them on the table to say, why should people be thinking about distributed ledger technology? Oh, sorry, I think something might be up with the slide. If we could flip to the next slide, that would be great. Thank you so much. You know, one of the challenges I do give to people when they talk to me about in my role of blockchain at EY, and you'd be surprised that I do challenge people, is a lot of the times I challenge people as to their reasons for using distributable ledger technology. And to me, FOMO is not a good reason. right? I think we do need to understand clearly, and I'm not a big fan of technology looking for a problem. I'm much more a fan of a problem and then finding technology to actually address that problem. And so to me, one of the key points which I like to do is first to discuss actually and understand what is it, what are the pinch points, the pain points that someone or an organization is looking to address using distributed ledger technology. From our perspective, where do we see some of the savings that arise? We see savings arising on costs. Why? Because we believe that if you put in distributed technology properly, correctly, etc., settlement times should reduce. Shorter settlement times mean lower settlement risk, mean lower credit risk, mean money sitting, money not moving, or money being in inertial positions for 2 or 3 days is less. And all of that then means less capital, reduced capital costs, and reduced capital costs arising from less requirements for risk management is always a good thing, which provides savings that can be passed on to at the end of the day to customers with regards to giving them more cheaper product. So one hand, definitely cost savings is what we see. Risk reduction is a second point that we also see. So that's the flip side of what I've just talked about: credit risk, settlement risk, operational risk, cyber risk. We all know of the very large, shall I call them reconciliation hubs, if that's a good phrase to use, that exist for many of the firms that are involved in the end-to-end value chain in asset management. If you're talking about distributed ledger technology, if you're talking about this being done right, you don't need reconciliations. You shouldn't need reconciliations. There's only one source of the truth. So what does that mean? And how does that, what does that mean to a lot of those organizations? What does it mean to reconciliation requirements? What does that mean to the people? What does that mean to the energy consumption? There's a lot of knock-on impact there. But again, to me, risk reduction opportunity as well. And then last but not least, revenue opportunities, right? So we think short term, I think it's a little bit more difficult on the short term, but we think longer term, definitely, with regards to tokenization, etc., which we're going to touch on in this webinar later on. And again, please, I'm talking to our IA audience, so you'll understand when I say this. If you can't tokenize something, if something isn't really going to work in an open-ended fund via that sort of structure, then it's going to be quite difficult to tokenize it anyway, because the liquidity challenges still move across. But if something is going to be easier to tokenize via the blockchain, then of course, this is, to me, one of the, again, great opportunities for us to progress with. If we now move on to the next slide, though, what might firms want to think about if they're looking at actual blockchain technology? Number one, regulatory concerns, right? I mean, I spend a lot of my time, and even yesterday I was on a BIS IMF call and various other conversations. The regulatory landscape is still changing between the US, between the EU, between various different countries, with us here in the UK. That regulatory landscape continues to change. I think actually we are in a better position this side of the pond than the US at the moment. Why do I say that? Because in Europe we have MiCA, which is MiFID for crypto assets. Whether you like it or not, the whole point, or the positive though, is that there is now some regulatory rules out there which allow firms who want to market on crypto assets or want to do custody across Europe to actually follow a set of rules and then actually passport across Europe. So firms that want to progress that way, they already have some regulatory certainty. In the UK, we are seeing a lot more push now as well to actually get that regulatory certainty and get that equivalence with regards to rules moving forward, which I think is a great place to be, versus some of the other countries out there. But definitely that is a concern, and one which is close to lots of people's hearts. Custody concerns, that definitely is currently a risk. Because when you start to talk about distributed ledger technology, the question about what are you custodying? Are you custodying somebody's USB key, which is their physical asset? Are you custodying their private key? Are you custodying some crypto assets? Are you custodying an NFT, a non-fungible token? If that's a painting, is that a financial instrument? What does that mean for me? What does that mean as my obligations? Those are definitely still considerations firms are looking at. Cyber risk, new risks arise from blockchain with regards to things like in the old world, I guess in the very, very old world, if you did have the key to the safe, you could do what you want. In the new world that we are living in, there is the proverbial key to the safe still, a private key, which, if it goes, effectively all your digital assets could disappear. But you also have the old risks, cyber and having that storefront, that digital storefront or footprint now means that you are open to, again, a whole new set of hackers and cyber risks, etc., which are going to attack your network. And sadly, we have seen an inordinate amount of that happening as well, as you will see in the media. So that is an old but new risk. Lack of understanding, I think that's pretty straightforward. But what we are definitely seeing is the second and third line now ramping up as well to start to have a conversation with the first line about what are these risks that are coming on board. But last but not least, I call it firms opting out. Some firms may, for many varied reasons, decide they don't want to make the leap at the moment, or they're not going to make the investment into distributed ledger technology at this time. As Gillian said, they might think that they're in a different part of the S curve and are waiting for something more to come. So, I think that is, that those are valid concerns. I then wanted to then move on to actually talk about crypto assets, which I'm sure many of you would also be quite interested in. But before I do that, I've got a poll question again for all of you. And actually, I just realized as I typed this, I meant does your organization currently trade cryptocurrencies? No, I'm not asking for any personal information as to whether you personally trade cryptocurrencies. That's up to you. So apologies. What we would like to understand from you as the audience is, does your organization currently trade cryptocurrencies in any way, shape, or form? And it'll be interesting to get your views on this as well. There's been a lot of press about firms accepting cryptocurrencies. But then again, I think what we find anyway is when push comes to shove, most of the firms might accept cryptocurrencies via the payment provider and very, very quickly flip that into fiat currencies anyway. Versus a few firms who actually would trade cryptocurrencies either for funds or their clients. So there we go. So 11% of you currently say that your firms trade in cryptocurrencies, and 89% say that you do not. So the 22% earlier on, which said their firms were already involved in blockchain technologies, I assume some of you are in that 11%, and that's a really interesting statistic. And again, I don't think a big surprise, judging from the various conversations I have with the industry with regards to cryptocurrencies and trading. And the reason why I said isn't a surprise is because of the slide now flashing up in front of you. It's complicated, right? We use the word digital assets or virtual assets, and we use those phrases in a very, very broad manner. And they do cover an absolute multitude of different tokens and different currencies. So, in front of you, you can see if you look at the bottom, a currency token versus a utility token versus, different CBDC, central bank digital currencies versus e-money tokens, etc., and stable coins, etc. And the point here for me is that actually the landscape is actually it's a pretty wide landscape. And you do actually need to understand what is it that you're actually trading, right? Don't take the name for granted. Do understand what is this token trying to do? How does it behave before you then try to understand how that token then actually interacts with the various different regulations that exist. And if we move on to my last slide. When we then start to look at what might firms want to think about if you're thinking about cryptocurrencies instead, number one is price volatility, right? I don't think I need to say very much there. And if I do, please just Google, Ethereum or Bitcoin prices, and you will see what I'm talking about. and that's an interesting price point at the moment. So if you are looking to trade cryptocurrencies for your clients, etc., to me, the conversation or the thought process about customer responsibilities, TCF type thoughts, etc., and how does that volatility sort of pan across, and the understanding is going to be quite an important consideration there. Regulatory concerns for digital currencies are the same. What are they recognized as? So if you just reflect on the previous slide I had with all those different tokens, different assets, different virtual assets may be treated differently because of their underlying. So, a CBDC, a central bank digital currency, or e-money token might be much more cash-like versus, what is a utility token? Or is my token actually representing a bond? So should it be treated more like that, etc.? So, the whole question about what is a token, what does it represent, is very much open. And in fact, my lawyer colleagues tell me that even until a few months ago, it wasn't even clear if you could possess a digital token, and therefore, if somebody stole it from you, you couldn't really argue that was theft because there wasn't anything to possess in the first place. So, a lot of changes are still needed to make sure that, in my view, the same rules apply to the new world that we are living in. Hacking risk with regards to things like the 51% attacks or degradation of blockchain technology, or where people can take over some of the chains, etc. as well. Again, is a new risk which firms wouldn't be so au fait with. The opting out point we touched on. Neoclear advisory fees, how are people going to start to charge their clients if you're a wealth manager or if you're an investment manager on the, is this just a tracker fund? Is there some sort of active involvement? Are we going to see this more in the alternative assets 2 and 20 type style? What are we going to see this as performance fees? What are we going to see in this area? Still looking to see that and where that progresses. Custody concerns, definitely so, with regards to, as I touched on, how do you actually show transfer of ownership? How do you show ownership? How do you hold those assets? And what do you do on those? And then how do you actually help with the trading as well? Is an absolutely key part, which I know a lot of the large asset services are now looking at this, looking at how they custody digital assets and what do they custody, and how does that then, how is that provision then given to clients? But some of them are debating, whether they go retail, whether they go institutional, right? Because if you go retail as well, many are still concerned about the AML KYC challenges, sources of funds. I've already started to hear stories from some of my wealth management clients to say, a client turns up with a whole bunch of crypto currencies. They want to then use that either as collateral for a loan, or they want to then cash that in to buy a property or something. How do you do things like sources of funds? How do you do your KYC and AML? Are some of the challenges firms are currently very much being challenged with. And that leads to number 7 on here as well, the lack of understanding as people start to upskill themselves. Yes, there's some great understanding in the tech teams, but how does that understanding then overlap with risk, with regulation, with regards to how markets currently are set up and how things could change? I think that definitely is a challenge there. But I also think it's an opportunity, by the way. And the reason why I say I think it's an opportunity is because traditional firms, though, they've got a good understanding of the regulations. For example, traditional firms have really good understanding of MiFID 2. And if it's MiFID 2 that now has been transplanted into MiCA for crypto assets, I would suggest that a lot of the traditional firms out there versus the fintechs actually have a very, very decent understanding of what those requirements might be. And so, I think it's interesting that this could also be a catch-up time potentially between traditional firms and emerging firms. And last but not least, this is all emerging technology. Different pieces are being held in different places. How do you join all of this together? How do you give the client a single view? How do you manage the client's portfolio on a consolidated basis? How do you report on a consolidated basis? Do you even have clarity on the taxation on all of these in different jurisdictions? Because that's still open as well. is all out there. So exceedingly quick ganter to the topic in the 20 minutes that I was allotted. I've got a slide to say any questions, but I don't think, Gillian, we have time. So I think I've got to pass this back to you, and maybe we can take questions on the chat or on the panel later on.
Thank you so much, G. Yeah, we have got quite a few questions that have come in, so maybe we can address those in the panel. I thought it was a really interesting session, and very interested to hear that 78% of people are not aware of DLT being active within an organisation, and that that as an organisation on the whole we're not trading crypto. But that was super interesting, and hopefully we'll get time to discuss some of the points in a bit more detail through the panel. But I'd now like to hand over to Josh Wade at Kellystone. Hi, Josh.
Brilliant. Thank you, Gillian. Thanks, everyone. We're going to talk through the realities of establishing new infrastructures and what it means in the asset management industry. Similar to G, we're going to race through this. We haven't got a huge amount of time. But we're going to start with a poll question, similarly. So broader kind of range here. So looking forward, which factor will be the most influential in driving industry change? We've got 5 options across the adoption of crypto and digital assets, as Jeet's just kind of talked through, the implementation of new technology infrastructures, climate change and ESG demands from investors, consolidation of players, and sort of M&A activity, or regulation as a broad topic. Obviously, there's a huge number of factors, and distilling it down into 5 options is always a challenge. But if you select now, and we'll have a look at the answers in a second. As those are coming through, I thought I'd briefly introduce Kellystone for those who aren't aware. Kellystone's been working in the industry since 2008. We're primarily known as a fund transaction network and powering sort of the distribution of funds between fund platforms and asset managers. And we now connect over 2,700 participants on that network as well. But more recently, we've been investing and launching a new service, which is called the distributed market infrastructure, which is a bigger play in this space of digital technologies and distributed ledger, cloud computing, and sort of technology solutions for the industry. Look at that, perfect timing. So by far away, kind of the winner by the looks of it in terms of the majority is climate change and ESG demand, which makes sense with the recent news of COP26. But also, surprising. I was thinking regulation would be a bigger player, but obviously implementation of new technology infrastructures and adoption of crypto assets are a big kind of trend in that world as well. So if we flick on to the back to the slide presentation, that sets us quite neatly. So if we flick on to the first slide, I actually wanted to start by stepping back from the asset management industry and talking about, in the broader context, how change and transformation happens across history. And if we go back to sort of Reformation Britain, which is a long way from the current day, there's a great example of how change and transformation occurs. With the in that period, the kind of dissolution of the monasteries that occurred at that time, what happened is that as the eviction of monasteries was going on, gentrified sort of innovators moved into those spaces and started to change the original purpose, because they had freedom and space to experiment. And overwhelmingly, what happened is they changed these monasteries into things like water mills. And if you kind of plot the kind of history and time going forward, that set the conditions for what eventually became the Industrial Revolution. And there's a wider point to be made there that as infrastructure changes, as new spaces are created, things like the internet or new technologies like distributed ledger technology or AI, you also create the space for innovators and change makers to freely experiment in those spaces and create new business models and create new models that can slowly be adopted and create the conditions for those great transformations and revolutions. And the important point to make here with relation to the industry that we all work in is that that's not possible. Those great changes aren't really possible from within the industry, because there's so much embedded process and workflow and technical debt that it becomes very hard to make those quantum leaps in transformation, because effectively you're path dependent and you're constrained by the operating environment that you're in. And if we click on one more slide, there's another example of that in kind of an industry that people usually associate with great transformations and human leaps, which is kind of the space industry. And a lot of people don't know kind of a fact about the design of the space shuttle. When the mission for a space shuttle was fairly clear, it was to take humans from the surface of the Earth, take them up into space, and return them down on a runway. But what a lot of people don't know is the design and the manufacturing of a space shuttle was constrained by two things. The first was that in between the kind of area where a space shuttle was put together and the launch pad, there was a tunnel, and there was also a railway track that you used to transport the space shuttle. And those two things combined served to constrain the design of the space shuttle, because the engines had to be limited in size to A, fit through the tunnel, but B, to be sort of light enough to be transported on railway tracks that had a standard width and a standard gauge. And both of those things, both the gauge and the width of the tunnel, were probably set at least 100 or 50 to 100 years before the idea for a space shuttle was created. And it's an important point to bear in mind as we go through the rest of the presentation, that both how the conditions for change are created, about creating new spaces and new areas for innovators to transform and to experiment, but also the realities of path dependence and the constraints on kind of an operating environment around us. But if we jump and we bring that back to the context of the asset management industry, and if we click on one slide, we can talk about the challenges that the asset management industry is facing. And most of these will be top of mind for a lot of the audience around market dynamics in terms of fee compression and kind of constraints on margins, but also in areas of regulation and meeting new demographics and the demands that millennials and new investors coming into the industry are making. But actually, we see that across multiple demographics about how you engage with your investments is starting to change, putting a lot of pressure on asset managers to adopt new technology or adopt new kind of operating models to meet that challenge. And if we click on another slide, the reality is that, as we all know, traditional approaches to solving those problems are no longer fit for purpose. In order to meet all of those challenges head on, it's important to not only do something completely new, but also to think about it in the areas of doing it on new technology and new infrastructures that haven't been kind of a core part of the process, but essentially acting as a bridge between the world that we have today and the new world. Even if we look at the structure for delivering investments to investors, the mutual fund hasn't been transformed in over 100 years or hasn't radically changed. And as we survey our community of asset managers and asset services on our network, the resounding feedback that we hear is that structures such as the mutual fund, the technology that the industry is running on, have potentially reached the end of their innovation potential, and what's needed is to move on to doing something new. And if we click on one more slide, I think the important thing to kind of bear out here is that the future of this industry isn't going to be created on legacy infrastructure. If you look at the first adoption of the internet, what was called Web 1, the first use cases for that were organizing the information on the web. And from there, you kind of created the conditions for companies such as Google and Microsoft in their Internet Explorer to create vastly valuable businesses to do that process. And if we click on one more, then as we've moved into Web 2, and we talked about it at the top of the webinar about these new kind of businesses that have come out even since 2008 that are much more in the sharing economy, the social economy, that have also created enormous value by delivering value back to individuals and thinking about things in a different way. And if we click on finally, and where much more relevant to this webinar, what we think about in terms of the emergence of Web 3 and this next kind of leap in terms of the infrastructure, there are also kind of businesses and models and companies that are creating their services in that world that are also going to be starting to deliver much more value over time, but radically transforming the way that the experience that we have interacting with our finances. And Jeet mentioned it in his presentation that there are differentiations to be made between the players in this space, between those acting in DeFi, in crypto, in sort of NFT world, but also traditional finance. But I think what you'll find is that the learnings from all of those different actors who have that freedom and space to experiment will be adopted slowly by traditional financial services, or the learnings will be taken from that. Now, if we click on one more, I think what we're sort of hearing from the industry is that resoundingly, and even more over the last 2 years, that there's growing agreement that this is the reality, that this is the direction that the industry is going on, that not only is it very hard to innovate in the current environment, but also that the future means of delivering value to investors will come through models which are tokenized, or models which are much easily to access through digital means. And that is borne out by sort of the focuses and technology investments that a lot of firms are making in areas such as crypto custody, but also investigating sort of the underlying technology as a means for delivering internal efficiencies or efficiencies between different players. And so this has gone from probably over the last 3 to 5 years as a niche topic to something that's much more at the forefront of the industry's mind in terms of how we transform and deliver value back to investors. And again, if we click on one more slide, what we're sort of hearing Calastone in serving our kind of community of clients is that the complete solution in this space, or an infrastructure that would be created to serve the needs of investors and to transform the industry and to deliver value back, kind of has to combine 3 things. One is an infrastructure that embeds cost saving at the core of it, that serves both the current state and the future state of the industry. The second thing is the ability to integrate all actors in the investment lifecycle. And that's not just existing actors, it's also new entrants, but the ability to have that cohesive universe of actors all operating on the same infrastructure with data seamlessly moving between all parties. And then finally, the third element is the ability to enable new models for investment to be delivered at scale and to be integrated to the distribution rails, both current and new, so that it is abundantly easy for investors to both understand the investments that they're making and making it much, much simpler, but also to gain value out of that in terms of embedded cost reductions that come from delivering new models that are sitting on this new infrastructure. And so if we pan forward and think about what the possibilities of that new world and the ability to experiment, if we click on to the final slide, if we think about how life could be different in the future, and when I say the future, I really mean over the next sort of 12 to 18 months going forward, is that the reality of establishing that new space that we talked about, the new space to innovate and experiment, which is already going on, and there are a huge number of parties already involved in this space, is that you can really imagine innovation and change from all the way from the back end to the front end. And I think the point about back end innovation and things happening in actually the sort of the investment life cycle, the core areas of investment operations, but also the market side and the routes to market that we all face, is that is where the core cost saving is delivered. It's all very well to create a pretty front end sort of app, but actually if it's still sitting on the same traditional rails, then you're not going to get the full benefit of cost savings. By moving sort of a traditional model onto digital rails, or even doing something digitally and doing that on digital rails, you're embedding much more efficient cost savings. But that carries through all the way to the front end. So you can imagine the ability to have real-time fund administration, or appending on new investment channels. So one of the areas that we investigate quite heavily at Calastone is how you connect either existing funds or new investment models to new routes to market, like the digital exchanges or new kind of apps that investors are increasingly going towards to manage their investments. And finally, that point about new investment models, this is kind of a piece of work that we've been working on quite heavily, is that it's if you think about how to package risk and assets for an investor, it's possible to imagine a world where that becomes much more personalized for the end investor's outcomes, because this is a really important point and theme that we hear a lot of, is that an investment product historically has been sold through the normal channels and traditional channels of wealth management. What we're moving rapidly towards is an investment product that is bought because it's implicitly understood, it's aligned to an investor's preferences, it's aligned to their goals, particularly in the context, and as the survey bore out at the start, about talking to the idea of COP26 and climate change being a major theme at the moment, to create a package of assets that's aligned to an investor's reaction to that serves their intended outcome, sitting that on an infrastructure that makes distribution very easily, administration very easy, and the issuance of those products very simple and cost effective. It becomes much more possible when you move into the new world. So that's essentially a snapshot of the world that we're moving towards, and how we think about infrastructure change and the move of the industry forward. As I say, this is research that we've been conducting over the last 2 to 3 years, and even longer actually, if you think back to kind of the dawn of the work that we've been doing with the distributed market infrastructure, to bring together the views of the asset management community and think about their priorities and develop an infrastructure that serves that whole community. And with that, I'll probably close there and either give back to Gillian or open up to any questions.
Thank you so much, Josh. That was incredibly interesting, and I really like the bit about the freedom to experiment. And as infrastructure changes, we need to create space for innovators and change makers, but an awful lot more in that presentation. We have got some questions, but I think they're going to have to wait till the panel, which we're about to start now. So thank you so much, Josh. If I could just invite John Allen, Fund Operations Specialist at the IA, and our illustrious panel, so Amarjit, Edward, Brian and Josh. I will hand over to you, John.
Brilliant, thank you, Jill. And as you say, really some fantastic insights there from Josh, and in particular those survey results that we saw there in terms of the use of tokenized funds and crypto custody in the future certainly is a good segue into the panel discussion that we're about to have now, which is going to focus specifically on funds. And as Jill says, we've been joined by a fantastic panel to talk specifically about the usage of DLT in the funds industry. And from my perspective, as a policy specialist within the funds team, this is certainly a subject very dear to my heart. And we have a lot of potential content that we could cover, but quite a short period of time. So we'll try and rattle through it as much as we can. Now, in preparing for this panel, I must say I've changed my notes and sort of the potential subjects that could come up quite a few times over the last few weeks, because lots of news keeps happening, frankly. We had the US regulator recently giving the green light to some crypto funds to be given authorization over there just in the last few weeks. That in turn has meant that Bitcoin and Ethereum's prices have reached record highs again as a result. A little bit further back in time, we had China deciding to go in much the opposite direction and cracking down really on all types of crypto activity. And then only yesterday, the Treasury here announcing a consultation on a central bank digital currency. And I think that there's, spoiler alert, there will be a UK digital pound in the not too distant future. So lots of things to look forward to. So a very topical discussion that we can have today. I should also mention that someone in the NHS used the phrase that there's an Amazon Prime mentality in the UK public, a lack of patience, people wanting everything served to them in a flexible way as immediately as possible. And again, I think that's something that can resonate quite nicely into our discussion today. But let's try and focus specifically on funds. That's our remit. We could easily go down several rabbit holes. Let's try and focus on funds. And I want to pass over immediately to Brian, because I know there's no better place to start. I know that he's done a lot of work recently on tokenized funds. Several UK OICs potentially up and running on a DLT ledger. So perhaps, Brian, you could start by, for those who aren't quite so familiar, describing what a tokenized fund is and your work on that recently.
Yeah, sure. Thanks, John. Thanks for the invite. So just a bit of introduction, I'm Brian McNulty. I'm the CEO and founder of Fund Admin Chain, or FAC. We believe that the funds industry, both private and mutual, will be transformed through the blend of DLT and tokenization. We'll maybe split them and come on to them in a minute. As John mentioned, we've designed and built the network and the software that enables fund managers to launch real tokenized, focusing right now on the UK OICs, but with an extensible product. We've now got 8 fund managers in our latest pilot doing that, looking at real fund launch. We're also working with the platforms to provide the distribution of those tokenized funds, and we're now up to 5 global fund service providers, transfer agents that are on our network to enable the trading and the settlement of those tokenized funds on a single distributed ledger powered network. So what it really allows you to do, and we'll answer your question directly in a second about the tokenization side, but what we're doing here is we're ultimately allowing the parties that we talked about to do what they do. We're not here to disintermediate parts of the industry. We're here to allow them to perform their important roles, but do it in a much more efficient way and to share data in a much more efficient way, while still providing a platform to enable that new product type, the tokenized fund, to move towards production and gain the benefits that I'll come on to. So we're the software, we're also the catalyst for collaboration. This is, as I think was been mentioned several times, this is about collaboration, and it's about getting through some big chunky hurdles that need collaboration. So we facilitate and we run the streams on the operating model, the practice, the future state operating model, the entire financials around what the market's going to look like very soon. The regulatory engagement, we're inside the FCA sandbox, but we work with the regulatory representatives across the fund managers, the distributors, the TAs, etc. And we go through those legal and technical considerations, put them into a roadmap as you'd expect, and crack on and deliver tangible, production-focused outcomes. And we're delighted to be partnered with the London Stock Exchange on that journey. So what we're talking about here with tokenization, if you break it down, the attributes of a tokenized fund, or a tokenized asset for that matter, enables a suite of actions to be acted upon, if you like, without needing to go to all the third parties that we're used to right now. So you can almost embed the legal stature, the rights of transferability, association. So it means that you can do a lot of actions that are not intrinsic with dematerialized assets or traditional paper-based assets. So if you take that tokenized, smarter way of almost putting rules into an asset, and then you bring the DLT side together. So the DLT side, the distributed ledger side, allows you to share data in a way that means you don't need to keep different copies of it. It can never go out of sync, and therefore you never need to reconcile that data. So if you bring those two things together, what you're really doing here is we are, and many others, it's great to see others in the funds industry, but in other asset classes, you're taking away as an initial step. You're taking away a lot of the inefficiencies You're taking away a lot of the unnecessary costs associated with data and risks associated with data, and driving that sort of initial step of simply cost out, whilst we build the foundations to allow this new product at the early stage to be created and reach new customers, and then at a mid-stage take further costs out, the different layers around distribution, the immediacy of data that go with these tokenized funds, and then at a later date open up a full plethora of benefits that I can come on to, John, if you see fit.
I think it might be worth doing that actually, Brian, because certainly as we heard from Jeet earlier, there's often the perception that technology is looking for a problem, or sometimes it's the other way around. So what I'd like to get to the bottom really of the tokenized fund itself and the benefits that it can bring.
Yeah, no problem. I mean, and we hit it head on here. It is a difficult business case for individual industry participants to push through their organizations with limited resources when you are basically unable to articulate the long-term benefits in a clear financial way. So I'm delighted to say there are like over 20 fund managers working with us now, and a lot of forward-thinking fund service providers that are seeing that we've had to work really hard on this business case so that we can actually quantify the nearer step efficiency gains and cost outs that we can get across the fees, across the operational inefficiencies that exist right now, so that we can justify the spend to go to step one. So I call that near term. Here's the risks, here's the operational efficiencies that we can gain. But the midterm is where we actually start to really take some of those costs out, switch things off, but we're also moving on to another layer of efficiency gains around federated KYC, streamlining regulatory reporting and compliance, and opening up. This is where it gets exciting. You're opening up into new customers and new types of flow, without getting into too much detail there. But then you're seeing the next layer of efficiency gains as well, where we're looking into the accountancy, the administration, the depositories, and it's not just the efficiency gains, it's actually having that real-time data as we look to bring the cash leg on as well. So this is all exciting at these mid-term, short-term we can justify the spend, but we're moving clarity how we can then better define the commercial upside and the next level of efficiency gains. But then coming on to where everybody's in a hurry to get to, it needs to be stepped. The long term, this Amazon Prime that you're talking about, I mean, we are through smart contracts and allowing the elimination of the if you like, the coded fund structures that we're used to. We can see that we're going to allow almost a direct access at a later date. We shouldn't underestimate the important roles that the different layers of distribution play and the different services that they wrap in. It's easy to just draw a box saying fund customer, fund, knock everybody out. It's not like that. We're working with forward-thinking organizations in those layers that can see that absolutely we can collapse those layers, we can get a direct access out to the customers at a later date, and we can start to almost we can get cheaper product out there. It's almost becoming taking the current wrapper structures away and move towards a secondary trading. By the time we get to that, then the regulations are evolving, as you've talked about there. We do see a convergence of the secondary trading across mutual and private funds and those venues and that liquidity and that new way for a customer to engage. That's exciting, but you need to walk it back and do it in baby steps. We strongly, strongly, strongly believe that these initiatives have to be collaborative, based on trust, done by many participants in the industry rather than one organisation.
Super. Okay. Now, G, your presentation referred to a number of organisations who are doing this in a number of places. Luxembourg, I think I saw South Africa on the list, Spain, France, and no doubt there's probably some others as well. I guess the UK in that respect is perhaps playing a bit of catch up here. But I'd just like to come back to Josh Wade and his analogy earlier about the rocket and the railroad, because obviously the rules that govern our industry were written many decades ago before any of this was conceived of. So, what's the regulatory picture here?
I think the positive there is the regulator is definitely interested in this. As Brian just said as well, he's in the FCA sandbox, and the discussions that we have with people there are very much that they want to get to a tech agnostic level of regulation, right? Even with my client money hat on, you can't have reconciliations in the blockchain, or they're meaningless. So so there is a challenge, shall we say, John, about making some of these regulations tech agnostic. But I think Brian's point to me is the key one, which is that there is value here for the end customer, right? And if you think about where the FCA is pushing for value for money, VFM, all that good stuff, right? To me, the case is there, but also as Brian says, the challenge is its network effect. Right, that's what we say to any client who wants to use any blockchain technology for anything. If you don't have network effect, there's not really much use to using the technology. But with that network effect comes the benefit, but also comes some of the pain Brian touched upon, which is to get it going in the first place.
Okay, let's turn Edward Callistone. We saw, I think it was one of the first polls that we had today showed that the vast majority of people in the audience felt that their firm wasn't using DLT. I suspect actually the number will be a little bit higher than that, because of course your DMI, your distributed market infrastructure, has been around for a couple of years now. Perhaps you could explain a little bit about how that works and perhaps some of the lessons that you've learned from it.
Sure, thank you, and really delighted to receive the invitation to be here. So thank you for allowing us to participate. There are actually a couple of points I think to touch on that actually you mentioned, and both the illustrious panelists as well. Very much appreciate the point that we just heard on the network effect, because I think that is, as a business, probably why we have been so successful, is about building that network and that critical mass, and then allowing that network to use its existing connectivity to access our distributed market infrastructure. So you have that critical mass, and you allow a frictionless or seamless way for that community. I think we operate in 48 countries to be able to access those new sets of services. John, you made a really interesting point. I think you might have said it was the NHS about, it sounded something a little bit critical around Amazon Prime. So I just like to put a little bit of a defense on the other side on that. I thought about this a lot during lockdown because of the amount of parcels that we seem to receive at home in the day and the nighttime as well. But literally how easy it was for the children to help us set up accounts on Amazon, to do the KYC and the AML and the linking it to bank accounts, to buying stuff, to paying for it, for sending it back when we didn't like it. And John, I know you were into transfers for funds, but that's what I call a transfer or a switch. And how it's just very easy to do that. So when people critique Amazon, certainly from a supply chain streamlining perspective, absolutely, I don't agree with that. And actually, our whole business for the last decade plus has been successful because we started with the premise of removing friction. When you think about Amazon, it's sort of very much as it's a fulfillment shop. It was a supply chain organization that then became very good on the client analysis and the front end engagement piece. But for our business, we always had the view that in any market, any asset class, any country, any client base, when you remove friction, volume goes up and cost and risk go down. And actually, when you look at Amazon Prime, and again, this is your example, in the US, you've got globally, you have 200 million people who use Amazon Prime. And the figures that I saw were that 69% of people who trial Amazon Prime go on to become clients of it. Can you imagine if our industry had a 69% conversion rate? And after 1 year, by the way, 93% of Amazon Prime users keep their subscription. And after 2 years, it is up to, I think, 98%. And if you look at Amazon stats, I think it's about half of all Amazon clients complete their purchase within 15 minutes. And it's 28% of those folks, 28% of their client base who complete their whole purchase transaction within 3 minutes. And if you look at why people like the service, statistics very high. I think 51% of the users say they like free shipping on Amazon Prime. 46% are around we can find products quickly. So it's all around that that seamless supply chain, frictionless. The whole thing works very simply, combined with, as Josh was saying, this very client-friendly front end where you can see what other people are buying. You can go and get in our industry, you might call it help or guidance and advice, but it's marrying those two parts, that frictionless supply chain, which, as we've discussed over the past half an hour, is much easier when you're using something like DLT technology, and again with that great client interface and customer insight at the front.
Brian G, any thoughts on that just before we move on? Okay, let's move on to investment by funds into crypto. Let's bring Josh into the conversation now. So, as I said earlier, US regulators tentatively approving funds. We've seen over $1 trillion of assets going into crypto ETPs this year, first year that's happened. In the UK, perhaps a bit more of a reluctance from regulators, perhaps. But Josh, what are you seeing in the market? You know, lots of hype around the demand. Are you seeing that?
Absolutely, yeah. And just for the sake of introduction, I'm Josh Goodbody. I'm the Chief Operating Officer at Credo. Credo is a provider of fully distributed infrastructure for the custody and settlement of digital assets. So really what we do is we work with funds, fund administrators, and various related parties to provide them the infrastructure for them to be able to really enter the markets with confidence. And so we as a business, of course, tend to probably focus on, should we say, the most engaged and active participants in the space. So folks that are actively deploying capital into digital assets, whether they are trading the spot asset or they're trading the futures markets, they're holding their crypto collateral somewhere, and they're increasingly doing so in a self-custodial manner. And we're seeing really for the last 6 months an enormous amount of inquiries from folks that really have traditionally sat on the sidelines. They have perhaps the highest fiduciary obligations, they have the highest internal burdens and rules before they can deploy capital into this new asset class. And we've spent a lot of time with them, telling them a little bit about what infrastructure looks like in the digital asset space and some of the common pitfalls that can arise when you start a digital asset trading desk. But in addition to that, we've actually seen some of these firms move very, very quickly from the point where they had not deployed assets into crypto 6 months ago to the point where, at least with proprietary funds, they're deploying assets into decentralized finance, which is an end of the spectrum of digital assets, which is perhaps at the riskier end. And so we've seen that shift to be remarkably quick. And one of our partnerships is with MetaMask, and we've partnered on something called MetaMask Institutional. And really what that is a market access tool to enable primarily hedge funds, but also some asset managers to give access to their end clients and funds to the DeFi markets. And we've been working with some of the largest hedge funds in the space to give them access to those markets. And the conversations they're having with some of the institutional relationships that they have is that there's this serious interest around getting access to certain products, whether those are yield generating products, whether those are products that can give them some kind of return on holding a stable coin asset. And this really is increasing month on month. So whether it's levels of interest through to actual folks getting deeply involved in deploying capital into the space, we've never seen such levels of interest as we're seeing over the last couple of months. And people are committing capital to the space, building the infrastructure they need to actually access the markets at scale and with confidence. And we think that this very much is the beginning of the trend. And we always talk about this in the space: is institutional money coming to crypto? It is in crypto, it is here, and it's here to stay. And I think that wave of activity is very much at the beginning of the curve. We're seeing huge amounts of interest, and it's very exciting for us all, I think.
And would you have any requests of the UK regulatory authorities in this respect? I mean, I guess there's been some very pessimistic language coming out of them over the last year or so. Presumably funds would be a safer, better way of retail investors, at least, to get access to this asset class. So how could they help?
Absolutely. I think the regulator has always had a really clear mission to protect the consumer. Now, how the regulator does that in crypto is up for discussion. We've seen different approaches from the FCA over the last 18 months or 12 months even. And really, if you boil this down to its first principles, if you give a retail consumer the ability to access a product that is regulated, whether it's the index that fund is using to track the assets it holds, or whether it's the provider of an instrument is regulated themselves, that's the best way to protect the consumer. And I think the regulator has been in learning mode for an awful long time here in the UK. And we really would encourage, if I was able to speak to the regulator, directly and have this conversation, it would be to encourage them to move quicker to help facilitate the build of these products at a much larger scale. I mean, they're accessible today. There are ETPs accessible to consumers today, but getting your hands on them as a consumer isn't that straightforward yet. The distribution channels are not as widespread as they should be. And so embracing that in the UK, making the UK hub for the build of these regulated instruments is absolutely beneficial for the consumer, but beneficial for the overall fintech sector as a whole. And we have the experience in the UK to build these kind of instruments and these kind of products. We absolutely should be doing more to grab the opportunity while it's clear and present.
Any other thoughts on that? Any disagreements? Jeet, perhaps you're closest to it.
I think the point I would just make, and I think to the point Josh made, yes, there are products which people can access already. There are Swiss funds, etc., which are already on UK platforms, for example. I think the flip side on all of this, the education piece, which the industry needs to also think about, it's quite important. The work the FCA put out with regards to most recently, was it 70% of people were buying cryptocurrencies because they were keeping up with the Joneses, for want of a better expression. The fact that most of them had actually borrowed money to buy into cryptos, again, is not a good statistic. The fact that even my managers tell me in the gym, the conversation is actually about coins and which coin is going to be the next one to go up. And what we just saw, for example, with the Squid Game, coin, right? I think the regulator is correct in its nervousness, but I also think that it's a fine line to walk, because if you don't actually, as Josh just said, set up appropriate vehicles for people to invest in, they're going to go offshore, right? Or they're going to do it directly, and in that situation, you've lost all ability to control, to regulate, and to protect. So it is a fine line, which I think we do need to walk to show the benefit to people as well of what we're talking about, but also to be clear about where this goes. We at EY, for example, are really big believers in DeFi, right? We think DeFi, and our global blockchain summit was actually on DeFi. We think there's a lot of legs in DeFi. Again, it's a disintermediation, like Brian said, right? But again, DeFi also does come with some of its challenges. A lot of what DeFi looks like currently is the early world of P2P, right? Where now all of a sudden people are saying, oh, I want to know who I'm actually trading with. That sounds like a central intermediary to me. So I think, we do need to walk into some of this with eyes open as well, John.
Yeah, great. We're very nearly out of time, but let's just spend a minute or two looking at the future. Edward, fascinating comments earlier about Amazon. How can the funds industry learn those lessons? What can it do practically to take things forward from here?
So from a practicality perspective now, there are great swathes of the supply chain that are still left to be automated. So I think, again, I go back to this phrase the whole time because I've been using it for the last 2 decades, which is the purest form of alpha is cost reduction. And there's still a tremendous amount of unnecessary friction, cost, and risk in the funds ecosystem that we need to be ruthlessly efficient in ripping out. So that's the first thing, and that's where we work very closely with our clients and industry bodies on the different parts of that supply chain which are broken. They're very country specific. Sometimes it might be around transfers, it might be around KYC or AML, it might be around dividends, but there are definite parts of the current supply chain that can be automated. Looking forward though, I think that what we've been working on the DMI for the last few years has shown that the current model for transfer agency is broken. It's not future-proof, and therefore I think the 2 areas where I see most progress being made at the moment around the new models of fund services. So certainly that's the back end piece, but then again a tremendous amount of progress to be made on the front office side of things, or the client facing bits. Tremendous amount of progress on new products, so particularly things like, in the institutional world, people are used to seeing SMAs, so separately managed accounts. We've been working with a number of players now about how you take that SMA idea, that separately managed account, or you could call it a fund of one, if you like, that mass personalization to mass market. So how do we make our industry not just better, faster, cheaper, but more compelling, understanding what the client wants, providing them real insights and products which are genuinely compelling. The fund industry, the first fund came out in Q1 or Q2 1924, and our industry has not radically transformed itself since that time. Fine, we've seen a little bit of innovation with passives and ETFs, but the progress that we've made certainly over the last 18 months during lockdown, working with various administrators, asset managers, and some big distributors, show that the tokenized fund model, the fund of one, SMA stuff is all very, very within immediate reach, and combining that with making today's supply chain an awful lot more efficient, I think gives us, all of us, a brighter future.
Great, thank you. Brian, 10 seconds, what's happening for you next year?
So hopefully, I mean, through collaboration, it makes things more efficient, and it also makes things go faster. So we want to increase the number of fund managers that are collaborating. So if you want to start the journey, learn, experiment, reach out to us. If you want to go one step further and actually get involved in the collaboration, coming back to the FCA, if we all engage the regulator individually rather than engaging as one, it's less efficient. If we all do a business case individually rather than one, it's less efficient. If we get involved in initiatives that are all about protecting revenue rather than looking at ripping up the book, looking at it through a very forward-thinking way, then that's the best way of operating. We've got that. Come along, join your peers. You've got 8 fund managers launching real funds. So if you're not involved in that journey, you're falling behind, the benefits that come out that we talked about earlier. So we're a very welcoming bunch of people. Reach out if you're any part of the industry, a competitor, fund manager, TA, distributor. We'll be delighted to engage and collaborate with you.
Very good. Thank you, Brian. And Josh, is 2022 the year crypto finally goes mainstream?
Well, I think maybe I'm getting ahead of myself. I think crypto has gone mainstream. Now, whether or not it's going to go even more mainstream is the question. Arguably, I would not be doing my duty if I was going to disagree with that. So absolutely, we think so. The collaborations we have planned for next year with very large household names and financial services organizations are super exciting, and they will take us further towards elements of crypto going even more mainstream. But everyone on this panel sounds to be doing their own part of that, and it's I think immensely exciting for us all.
Great, thank you very much, everyone. Jill, I think that we've shown that DLT in the funds industry is certainly up and running and has a bright future. So over to you.
No, absolutely, and thank you so much. That was such an interesting panel, and all the presentations today were incredibly useful. Any questions that have been posed and we haven't had chance to answer, we will get back to you personally on those. And it's really interesting. The future requires change, doesn't it? It requires change for infrastructure, and traditional approaches are not fit for purpose. I think we've had some fantastic stats today and some great quotes, and Amazon, I think, has done quite well out of this panel. But thank you all, and thank you everybody for joining us today, and we very much look forward to continuing the conversation. Have a good afternoon.